Welcome. In this video, when will the XCN coin big rally come? We will analyze it. Don't forget to subscribe and like, and please watch to the end to understand. When the technical structure shown in the market's larger time frame is carefully examined, it is clearly observed that we have entered a highly critical phase within the context of the long-term Elliott wave theory. The current technical outlook indicates that the price has completed its second corrective move in the larger cycle and is now strongly stepping into the third wave. This third wave is one of the most important components of the impulsive structure and typically represents the phase where the market experiences its strongest, most decisive, and highest volume rally. According to Elliott's core principles, a trend consists of 5 main waves. The first wave is an upward move, the second wave is a correction, the third wave is a strong upward move, the fourth wave is a horizontal consolidation, and the fifth wave is the final phase of the uptrend. In the current analysis, based on the structure becoming clearer in long-term charts, the first wave ended with an upward attack, followed by a second wave pullback, and now there are strong signals that the third wave has begun. The completion of the second wave is often a breaking point in investor psychology, where uncertainty and fear give way to a renewed sense of direction. Therefore, the start of the third wave is typically accompanied by significant technical and fundamental developments. The third wave is not just an ordinary bullish wave. In technical literature, this wave tends to be the longest or strongest wave. Especially after the correction of the second wave, momentum begins to build, and investor confidence returns, leading to a fast and decisive upward move. For this reason, the third wave is often associated with the 1/618 Fibonacci extension level. This level technically suggests that a price rise equal to approximately 1/618 times the length of the first wave is reasonable. This underscores that the third wave is not just any rise, but the main wave representing the true strength of the trend. In some cases, this strong wave doesn't stop at the 1/618 level. It can extend even further to levels like 2/272 or even 2/618 Fibonacci extensions. This reflects a period where market participants have high confidence, new investors are entering on a large scale, and trading volumes increase significantly. The current technical structure may be indicating such potential. Especially when compared to the volume observed during the first wave, it's quite natural for the third wave to perform much stronger in terms of volume. This increase in volume often signals the entry of institutional investors or large capital movements, which in turn accelerates the third wave. Reaching the 1/618 Fibonacci extension level is not only a theoretical target, but also one of the strategic positioning levels, frequently watched by technical traders. Since this level is calculated based on mathematical ratios of previous wavelengths, it is considered quite reliable. If market psychology, fundamental developments, and volume support accompany this structure, it becomes highly likely that the price may surpass this level and reach even 2/272 Fibonacci levels. These points will be critical zones showing how strong the third wave truly is. Investor psychology also begins to shift significantly during the third wave. The fear and uncertainty that dominated the second wave are replaced by optimism and increased risk appetite. This psychological transformation typically represents a period in technical analysis where resistance levels are broken more easily, corrections are shallower, and buying activity becomes more aggressive. At the same time, media attention increases. Investors begin to talk more about the asset, and the price draws the interest of broader audiences. All of these developments clearly show why the third wave is generally the strongest and longest wave. But we can't make decisions based solely on Elliott wave analysis. Let's also look at other metrics. Stay tuned. When the overall structure of the price movements is carefully examined, it is observed that the long-standing downtrend dominating the market is reflected through classic technical patterns. During this process, the consecutively formed lower highs and lower lows on the chart indicated that selling pressure continued. The market was moving downward, and overall investor sentiment was shaped negatively. However, recent price action is giving the first strong signals that this structure is beginning to change. Within this downtrend structure, each time the price attempted to form a peak, it failed to surpass the previous level, and with each pullback, it dropped below the prior low, reinforcing a negative market cycle. But recent developments suggest that this classic lower high and lower low pattern is about to break, and the first step of this breakout has even occurred. The price has formed a new high above levels it could not break during the long-term downtrend, marking the first higher high. This is an important signal in technical analysis, indicating the weakening of the downtrend and that buyers are starting to regain strength in the market. This initial upward move is often considered the first step of a new trend. However, to confirm a real uptrend, just forming a higher high is not enough. In the next stage of this structure, the price must hold above the previous low during any pullback, creating a new higher low. This is the point where a trend reversal is both theoretically and practically confirmed in technical analysis. If the price, during this correction after the recent rise, turns back up above the previous low rather than falling below it, it proves that the market is no longer making lower lows, but is instead moving within a new structure. This results in the formation of higher highs and higher lows, signaling the technical start of an uptrend. This pattern is one of the most reliable signals for medium and long-term investors to initiate buying strategies. This technical reversal also plays a decisive role in investors' decision-making processes. Traders who had been on the sidelines or holding short positions during the series of lower highs and lower lows begin to switch their positions once they see buyers gaining strength and the potential for a price reversal increasing. This triggers new buying waves and causes the price to move toward higher levels. Thus, the technical reversal acts as a catalyst that increases demand on the price. Another important aspect to watch at this stage is whether the newly formed low is a strong support area. If this level has been tested multiple times in the past, and the price has reacted at this level, the resulting higher low is supported not only structurally, but also psychologically. This helps the uptrend to be built on a more solid foundation. Similarly, an increase in volume indicators signals renewed investor interest, and that the new trend may proceed more securely with volume support. Trend reversals often begin with small but meaningful signals. These signals can chain together and lead to large price movements. The fact that the price has abandoned the previously formed lower lows and lower highs to create a higher high is the first link in this chain. The continuation of this chain will come with the formation of a higher low. If this structure is also technically completed, the downtrend will officially give way to an uptrend. Given the current technical outlook, the MACD, an important momentum indicator often used by investors and traders, is heading towards a critical point. This indicator provides important information about the direction of the trend, the strength of momentum, and potential turning points. Especially in periods when the price movement is uncertain and the trend is not clear, an upward crossover in the MACD is considered as a harbinger of a new uptrend in the market. At the moment, the charts are signaling that such a pattern may occur very soon. The MACD indicator basically consists of two exponential moving averages, usually 12 and 26 periods. The difference between these two averages forms the MACD line. On top of this line, a 9-period signal line is added. The interaction of these two lines provides critical information about the direction of the market. In particular, when the MACD line crosses the signal line from bottom to top, it is defined as an upside cross in technical analysis, and this is one of the leading signals of a potential price increase. We should wait for the cross. Yes, friends, I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.